Welcome back to Magnolia Bank Academy. My name is Dan Mason, and in this video, we're going to be walking through the ins and outs of mortgage insurance. So hopefully you've already watched the Mortgage 101 Introductory into Home Loans, where we touch on a high-level overview of how mortgage insurance works. In this video, we're going to dive into the details of conventional versus FHA mortgage insurance, explain it so that we make sure you understand how each one compares. So with that, let's dive in. So we have prepared a breakdown or an Excel spreadsheet that is available by clicking on the link down below. You can open up this spreadsheet and adjust the numbers to customize for your specific situation. So feel free to open that up and maybe even walk through it with me as we dive in here. So as you can see on the left, we've basically put in a sample purchase price of $400,000. We used a property tax rate of 1%. Feel free to adjust these numbers to your individual scenario. And we also put in an estimated annual insurance amount of $1,200, which should be in the ballpark, but feel free again to adjust. So let's dive into conventional mortgage insurance first. So conventional mortgage insurance is dependent upon the amount of money you put down. So think about mortgage insurance like this. It's not a burden. Of course, you'd like to avoid paying mortgage insurance. And how do you avoid paying mortgage insurance? You put 20% down. With a 20% down payment, or as you can see here in our spreadsheet, 20% of a $400,000 purchase price is $80,000. With 20% down, there's no mortgage insurance. Not everybody has 20% to put down. That's a good chunk of money on a $400,000 house. So mortgage insurance is a tool to be used to allow you to buy a home, let you purchase a home with less than 20% down, and get you into the world of home ownership, all without having to save an enormous down payment amount. So what is mortgage insurance? It protects the lender. In the event that you were to default on the home loan, the investor, the lender, would be secure, would be insured so that that loan gets paid in full. You as the home buyer or homeowner don't get anything out of it. It's purely there to protect the lender. But again, it's a tool to be used so that you don't have to save an enormous down payment. So let's explain how it works. So on a conventional loans are designed for higher credit scores. If you've got excellent credit, you're most likely going to go with a conventional loan. So mortgage insurance is based on risk. The more money you put down, the less risk there is for the lender because, of course, you have more skin in the game and they've got more cushion in the equity. So if you go with just a bare minimum down payment, so let's go with a 3% down payment with an excellent credit score. So in this hypothetical scenario, 3% of $400,000, as you can see here, is $12,000. That leaves us with a loan amount of $388,000. We've used a hypothetical interest rate of 6.75. Please don't read too much into that. Interest rates are up and down every single day. This is just for illustrative purposes. But at 6.75 on a loan amount of $388,000, the principal and interest payment would be $2,516. We then have a property tax amount. Again, we used 1% of the purchase price for property tax in this hypothetical example. So it's $333 a month. Insurance, $1,200 divided by 12 months works out to be $100 a month. And the PMI on with an excellent credit score of 740 with 3% down is about $119 a month. So your total payments are $3,069, assuming you've got an excellent credit score. Now, you increase that down payment to 5%. All these numbers adjust. 5% is 20 grand down. Loan amount's a little bit smaller. And keen-eyed viewers will notice that the interest rate's a little bit better with 5% down. And that's because, again, the risk is less. With a diminished risk, with an extra down payment, the interest rate does get a little bit better. It's usually about 0.25%. Every scenario is unique. We're happy to run those scenarios for you. But all with a 5% down payment and 6.5% in this scenario, the payment is $2,401. Tax and insurance the same. You can see here the PMI is cheaper at $85 a month, bringing your total payments to $2,920. And this scale continues. You put down 10% down. Again, you can see the PMI is a little bit less. 15% down, very minimal PMI because you're putting down such a large down payment. And this 15% down is an interesting scenario because a lot of people look at this and say, man, I don't have the full 20% down. I don't have 80 grand to put down, but I do got 60. Man, I hate paying PMI when I'm so close to that 20% threshold. So the good news is there is a solution for a conventional loan. And that solution is with lump sum mortgage insurance. So the way that works, if you click on the lump sum tab here on the bottom in the spreadsheet, Let's say we go down to that example. So with a monthly mortgage insurance of 15% down, this is just a carryover from the previous screen. You can see it's about $31 a month. The way that lump sum mortgage insurance works is that rather than paying that $31 a month, you pay a one-time premium. In this hypothetical example, again, $1,598 is the one-time premium you pay. As you can see, if we do that, it eliminates the $31 a month, and you have a lower monthly mortgage insurance, lower PITI payment, all without the mortgage insurance. So most people, when they're looking at that, they want to figure out, is it worth it? What's my break even? So we just simply calculate that over here. We say we've got a $1,598 one-time lump sum premium. You divide that by $31 a month, and that tells you that it takes you 51 months, or a little over 4 years, to break even. So if you keep this loan for 4 years, 51 months or longer, then you will be better off because you don't have that $31 a month payment beyond that 51 months. You're better off with a lump sum mortgage insurance. If you're going to sell, refinance, do something different within those 4 years, then definitely go with a monthly PMI because it is cheaper. So that then begs the question, is PMI forever? If I buy a house with only 3, 5, 10% down, do I have to keep that mortgage insurance forever? And the obvious answer is, of course not. So the way PMI works, it is automatically canceled once your loan reaches 78% of the original value of the home. By original value, we mean in this example, that's the purchase price. So $400,000 times 78% means a loan amount of $312,000. Once you pay that principal loan balance down to $312,000 or less, then PMI falls off automatically. You don't have to do anything. So you might be wondering, well, how the heck do I figure out when it's going to be at $312,000? That's where the amortization calculator comes in. So we click on that tab on the bottom, we put in that scenario. So here we've got a 5% down payment or a loan amount of $380,000, and the amortization schedule will break it down for you. So at the end of month number 1, your balance goes down to here. And so we want to look at this ending balance column and find where the balance gets to $312,000. So we scroll down here, boom, there it is. Month number 135, or that works out to be 11.25 years. So a little over 11 years, the balance hits $312,000, and that PMI falls off automatically. And again, this is all dynamic, so feel free to adjust these numbers to your individual scenario. But 11 years is a long time. And so your value of your home over time will be going up. So the nice thing about PMI is it can be removed as long as you keep it for 2 years. So if you keep that loan for 2 years or longer, the value of your home has gone up, the principal balance has gone down, or some combination thereof, and you are now below that 80% threshold. You can have PMI removed by simply reaching out to our customer service department, request those the PMI removal forms. They'll send you over the forms to fill out. We then have an appraisal done, verify the current value of the home, compare that to the principal loan balance, and if you are below 80% loan to value ratio and you've had that PMI for at least 2 years, then that PMI can be removed, save you that much more money. So that's conventional loans in a nutshell. FHA loans work a little bit different. So with an FHA loan, we're going to use those same hypothetical scenarios. So FHA loans are a lot more flexible. Most first-time home buyers will use an FHA loan. They allow down to a 580 credit score, a little bit higher debt-to-income ratios, a little bit more liberal underwriting guidelines to allow for somebody who maybe doesn't have a deep credit history. Maybe you're young, still establishing credit, or maybe you're human and you had a hiccup in your past. FHA is a little bit more flexible. So with FHA, it allows for as little as a 3.5% down payment. So you can see we use the same hypothetical purchase price. 3.5% of $400,000 is $14,000. That leaves us with a loan amount of $386. So the unique thing about FHA mortgage insurance is that there's 2 components. You've got upfront mortgage insurance premiums, or MIP, which is a lump sum amount. This is 1.75% of the loan amount that is tacked on top of your loan balance. It's not paid out of pocket. You don't have to come in with a check at closing. It is simply tacked on top of the loan balance. So you'll walk out of there, in this example, with a loan amount of $392,755. Then, in addition to the upfront MIP, you have monthly mortgage insurance premiums. So all of this principal and interest, tax, and insurance works just like a conventional loan, but the monthly mortgage insurance premiums on FHA are 0.85% of the loan amount. So that $274 in this hypothetical example is we simply take the loan amount times 0.85%, divide that by 12 months. That's how you get the monthly mortgage insurance premiums for FHA. So in this example, you would be paying PITI plus MIP would be $31.47 per month. Now, here's the thing with FHA mortgage insurance. It's the same whether you put 3.5% down. The only slight difference, if you increase it to 5% down, the upfront MIP is the same. So it's that same 1.75 factor. The only difference is that if with 5% down, the monthly mortgage insurance goes down to 0.8%, as opposed to a 3.5% down is 0.85. It's a nominal difference, but there is a slight improvement at 5% down. Now, with FHA mortgage insurance premium, here's the catch. You do have to keep that mortgage insurance premium stays on the loan for the life of the loan. No matter what, FHA mortgage insurance premiums stay on the loan for the life of the loan unless you put 10% down or more. You can see that spelled out here. If you put down 10% down or more with an FHA loan, then the MIP stays on the loan for 11 years and then falls off afterwards. So that begs the question, well, how the heck do I get rid of the MIP on an FHA loan? Quite simple. Just like a conventional loan, as you're paying the balance down and the value is going up, you're going to get to a point where you have 20% equity in the property. At that time, you would do a refinance. Put that into a conventional loan. With any luck, lower the interest rate, save yourself some money on the interest rate, and also eliminate that mortgage insurance premiums by refinancing out of the FHA loan and into a conventional loan down the road. So that sums up mortgage insurance. It's pretty straightforward. Think of this as a method and a tool to get you into a home and allow you to accomplish your goals and something that can be removed down the road. So once again, thank you for watching this Magnolia Bank Academy video. My name is Dan Mason. If you have any questions, please don't hesitate to reach out to me or any of my team members. We're all here to help. Thank you.